Section 2, recording closing entries. There's two parts of our accounts. There are permanent accounts and temporary accounts. The permanent accounts are assets, liability, and capital accounts. Our temporary accounts are the accounts that we'll be closing out, which will be our revenue, expenses, drawing, and income summary. Temporary accounts show changes in the owner's capital account. Balances of temporary accounts are summarized and transferred to the owner's capital account and begin a new fiscal period with 0 balances. Closing entries. Balances must be reduced or closed out to 0 at the end of each fiscal period. To close, amount equal to balance recorded on the opposite side of the balance. So if we have a balance on the debit side, to close it out, we put the same amount on the credit side and vice versa. An example, our account is debited $3,000. To close the account, another account, income summary, must be credited the same amount. Income summary, used to summarize the closing entries for the revenue and expense accounts. Normal balance side, balance is determined by amounts posted at the end of the fiscal period. Temporary accounts, this also gets closed out. Income summary. So when the revenue is greater than our expense, we get our net income. And when the revenue is less than our expense, we get a net loss. This we've learned from a previous chapter. So for income summary, this determines if it's going to be a debit or credit side. So on the T account here, debit would be our total expenses, and credit would be our revenue when revenue is greater than expenses. So when closing out our closing entries, this is the process that we would follow. So first, our revenue would close out to our income summary. Then our expenses would close out to income summary. Net income or net loss would be labeled income summary, but it closes out to capital. And then our drawing would be closed out to capital. So again, we'd have a debit and credit here. So if it's debit, we write that first, and if it's credit, that's being written second. So we would label it closing entries. Then we write down our sales, take our sales amount here, bring it down, and then close it out to our income summary, so it just goes to our income summary. Same with our expenses. First, we list all our expenses. The total of our expenses would be the amount for our income summary. So here we have our work together as our sales is 5,510 or 11, I mean, and then we have our expenses. We would use this information to put on our documents. So first we did our adjustment entries. Now in section 2 we'll be doing our closing entries. We start with the date. So then we write down our sales, which will go to our income summary. We have our 5,000 for our debit for our sales and credit for income summary. Next, we do our expenses. First, we list all our expenses. The total of our expenses would be our amount for our income summary. When putting them into our T accounts, we will label them closing, and we put the amount there. So for example, looking at our advertising expense, the original balance was $213. On the debit side, we close it out by putting it on the credit side, and the balance becomes 0. So we did steps 1 and 2 here. Now steps 3 and 4, where if we have net income or net loss, we label it income summary. It'll be closed out to our capital account. And then drawing goes to capital. So First, we list our income summary, which is our net income. So we take our 2,000 amount here, bring it down, and then it goes on our credit side to balance, and it goes to our capital. So in our example, for our work together, we have a net income of $3,330. This here would be listed as our income summary, and then it'll go to our capital on the credit side. Next, we do step 4, so drawing will be closed out to capital. So we take our drawing amount here of $625, we leave the capital amount, so take our drawing, $625, and we bring it down on the credit side and put it on the debit side for our capital. So on the T account here, we're closing out our drawings. We just label it closing for drawings, we know where it's coming from, and then we get our remaining balance. Our drawing account, our normal balance is on debit. We're closing it out. On the credit side, we get a remaining balance of 0. So, on our work together, we do our drawing of 2,100. And we put that in our drawing on the credit side, so it's the opposite. And then we send it to the capital on the debit. And then lastly, we would need to post all these to make sure that they close out to 0. And that is section 2.